Hello everyone, I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. S.N.S. Rajalakshmi College of Arts and Science. I am here to explain a concept, management accounting in the course cost and management systems. Now we are going to see the introduction about the management accounting. First we should know what is meant by management accounting. So it is a process of using accounting data for managerial decisions. So management has to take decisions in order to run the business. So to take the decisions, they need accounting data. That data is said that process of getting that data is said to be management accounting. We can see the nature. What is meant by nature? What is the nature of management accounting? So forward looking, analytical, decision oriented. Yes, it's a forward looking. So for the next year, the management has to take the decision how much to be produced, what to be produced, how much to be produced, how much amount is to be allocated as a budget, what is the price to be fixed, how to source the finance. Everything is forward looking. So they use some techniques in order to calculate all these things. That is analytical. And these are for decision, but to take the decision. So it is said to be decision oriented. Now we are going to see the functions. What are the functions of management accounting? Planning, controlling, coordinating, decision making. Very important. So they have to plan, they have to control the cost, they have to coordinate everything in order to get the end result. And their main job is decision making. They should not go into a loss. They should not waste their manpower or money or their management. So they have to be in a good position to take proper decision making. And now we are to the importance. What is the importance of management accounting? Improves efficiency. If management accounting is, if the accounting data is clear and it is processed, then the what to say here, the business will get improves, it will earn more profit. It helps in forecasting, it supports strategic decisions. So for all these things, management accounting is needed. It is important. Everything has certain limitations. Management accounting too have some limitations. That is, it depends on data accuracy. If a data is not correct data, here the decision making cannot be a right one. So the limitation is it depends on data accuracy. It is subjective in nature. Then we are going to see what is meant by ratio analysis. Here the management accounting has an important tool or technique called as ratio analysis. That ratios are used to evaluate financial performance of the company, business, organization. So current ratio, liquid ratio, stock turnover ratio, debt equity ratio. So there are many ratios. All the ratios are evaluated to find out the financial performance of the organization or the business. Next is the liquidity ratio. So liquidity ratio. So in the ratio analysis, we have liquidity ratio. So liquidity ratio is used to measure ability to pay short-term debts. So they will calculate current ratio. So current assets by current liabilities. Quick ratio is there. Likewise, they have profitability ratios. Profitability ratios in order to find out the profitability of the business. Measure earning capacity, gross profit ratio, net profit ratio, return on investment. These things are calculated in order to find out the trend of the business. So it comes under profitability ratio. Next, we are going to see fund flow analysis. Fund flow is nothing but movement of funds, that is working capital. Movement of funds means how we get a fund and how we are using that fund. So objective of this fund flow analysis is identifying the sources and uses of funds. So business needs funds. Without fund, business cannot be executed. So the management has to see what are all the sources of bringing the fund inside the business, and it should be properly utilized for the business. Analyze financial changes. These are the objectives. Fund flow statement is to be prepared. So there are 3 steps. What are the 3 steps? First, they have to calculate the changes in working capital. After that, they have to find out the funds from operation, and they have to prepare a statement of sources and applications of funds. This is the 3 steps used for preparing the fund flow statement. Next, cash flow statement. Cash flow analysis. So, cash flow analysis means tracks actual cash movement. So, what are the cash flows? What are the types of cash flows in the business? Operating cash, investing cash, financing cash. There are 3 types of cash flows. Now, we are into the concept called as marginal costing. So, only variable costs are considered here. We have to find out what is contribution. Contribution is nothing but sales minus variable cost. We have to find out the break-even analysis, that is nothing but fixed cost divided by contribution per unit. So this break-even analysis shows the level of sales where no profit, no loss. This is a very important concept, break-even analysis, no profit, no loss. Next, we have to see what is budgeting, planning future financial activities. So budgeting is a very important thing. Sales budget, cash budget, production budget, flexible budget, everything we have to allocate the amount. So it is a planning for future financial activities. Next is budgetary control, comparing actual with budget to control performance. See, we have allocated 1 lakh. Actually, it is 1,10,000. Comparing in order to control the performance. Next, we have to see what are all the types of budgets. Cash budget is there, sales budget is there, purchase budget is there, master budget is there. So, there are different types of budgets in order to calculate for the business efficiency. Thank you. I hope you have got some inputs about what is meant by management accounting, what are the things that comes under management accounting. Thank you for the patience listening.